Two indicators triggered this week. Both have 100% track records with calling a recession, and it has a lot of people freaking out. But as investors and traders like you and I, what does the data really suggest happens next? And should markets actually be performing the way they are? Today we investigate stocks, commodities, and cryptos together for the next couple of weeks into the next few months. Join us for this special show. It's going to be a good one, guys. Let's get into it. Well, welcome back, everybody, to a special weekend edition of The Daily Show. My name's Tom. Today, we're talking about everything from a top-down perspective because we need to look at what Wall Street is doing sneakily underneath the hood. If it's your first time here, remember to subscribe and smash that like button if you love everything to do with stocks, commodities, or cryptos, because we cover them here daily. And what a week in review we had. Before we go into some data that will blow your mind, and of course some key charts and analysis, I want to just talk about what we saw, some historical moments. A full-on meltdown on the VIX going from 23 all the way to 65 basically was like seeing a global financial crisis on that particular index. We also know that the S&P 500 fell over 3%, and it was down as much as 6 on the NASDAQ during our live show on Monday, where we managed to sync up semiconductors, silver, and the S&P 500 to amazing supports, helping us to kind of define that we were probably oversold during that session. What a trading week it was, what a buy in the dip zone it was as well. And we saw a secondary entry throughout the Thursday. A lot of replication this week, which I think is exciting. And of course, if you ever want to find out more about that replication, we have it in our day trading and advanced courses. Links in the description down below. Let's talk about unemployment rate though, because of course, this is one of the indicators that has a 100% track record with calling recessions. Now, why is that? Well, unemployment rates are generally a lagging indicator, but the market will come in a certain way. Generally, the market sniffs this out early and it freaks out well in advance by slowly selling portions to us as investors and getting us in right at the top. Now, you could argue that may have happened with AI. Of course, we've seen a huge slowdown in NVDA, which we suspected a few weeks ago, or actually a month and a half ago now, was going to happen. And we saw that in the charts already. But is this what we call a pullback or a correction, a pullback in time or a correction, or something more sinister? Well, of course, unemployment rate is driving up. And we know that central banks around the world are actually doing this by raising rates. Now, what they're going to do is try to engineer a soft landing. And remember, it's the way in which they do the rate cuts that will be important for us to take a look at. We've got some statistics around that moving forward. But of course, these jobs numbers, they're always fake. They get revised up, down, and all around, generally down. And we know that a lot of them could be temporary layoffs. You can see here, according to the latest Goldman Sachs report from Mike Zaccardi over on X, we find no evidence that Hurricane Beryl, which remember Fundstrat believed could be there, in Texas contributed to the rise in temporary layoffs. But summer auto plant retooling shutdowns might have contributed. So in general, this jobs number is already looking a little bit kind of dodgy when you start looking at it. Another one is the SARM rule. We saw so many people talking about this, and in many ways we debunked it last week because basically the creator of the rule actually said, I don't think it's going to be working this time around. Now, another thing is, as we mentioned, the market tends to sniff out these problems early because, again, this one can be a bit of a lagging indicator. And you'll notice here that in previous triggers of the SARM rule, generally we're already seeing a bit of a downward movement from the markets, and they're already well established in terms of how things have started to fail. And we showed this with the stats because, of course, when we saw these reads on the SARM, we noticed that the market had often already been in a recession, and you can see here where the recession was starting. And it's very important to know this. The market is not stupid. In fact, the market is quite smart and fairly efficient at doing one thing: stealing our money. Yeah, stealing retail money is the easiest money to steal, and uninformed hedge fund traders, of which there are many, because of course we know the statistics surrounding hedge fund traders could be like, I think 35% of them or even less beat the market even over a 1 to 2 year period. So because of this, we now start to say, okay, well, what really is going on? If the SARM rule is not really triggering properly in terms of it's probably not saying a recession's right now, unemployment's certainly rising, it's no doubt that we're probably going to go into a recession because the bond market is uninverted, or did uninvert, but still inverted in terms of yield. This is one of the longest, if not the longest ever recorded for that, which means something bad is going to be brewing. We need to now start looking at the key things. Here's one that I've seen also floating around. We've all talked about it. 2023 versus 2024. Are they the same? Well, if they were the same, then we would continue to see volatility on this pickup into October. And of course, we've talked about this idea that there could be a double dip into October. This week, 5440, 5400 for the S&P will be pivotal to see whether the bulls or bears actually win over that area. But it's much more than this. We also had way too little puts. The puts were nowhere. No one was hedging. And we know this because, of course, on this chart here, which we've talked about before, we basically had nobody hedging with the puts. There were so many calls coming through in June. We know that July, the first 2 weeks, remember this for anyone that doesn't know this stat, are the best 2 weeks of the year statistically every single year. So if you ever want to know the best 2 weeks of the year, first half of July, great time. So we actually saw a little bit of hedging coming in during that period. Often some of our indicators were, of course, showing superior oversold markets at that area. And then we have a massive hedge on the puts. Now, because we have so many puts in the market, this puts us back to October and also the August period. We're basically at a point where we have a put wall. And this means that so many hedges went into the markets, it may be better for the market to either go sideways in chop or actually to show recovery, which is, of course, what we've been seeing. Some other just random charts I thought I'd put in there. Housing affordability is now the worst since 1985 in America. So, of course, this also shows us that we're probably entering into what we call a late cycle in the markets. Why? Well, housing unaffordably means lots of people are taking a lot of debt on. And debt is ultimately the thing that causes crashes. So remember that one, certainly worthwhile paying attention to. Another thing that causes crash is over some kind of concentrated market. And we've had this a few times. Of course, the most notable ones were the energy bubble of the 1980s into the 70s, the financial bubble coming into the global financial crisis, and the tech bubble during the 2000s. And the similarities with the tech bubble are becoming more and more and more clear as we start to see this concentrated AI market. You can see here, Infotech is now sitting at 32% of the overall market concentration, reaching up there with the tech bubble. Of course, different because over here, nothing made money. Over here, things are making money. But as they often say, the next bubble has to be bigger than the one before it. And that could be the way we're kind of leaning. Imagine if this market got to 35 or even 40% concentration of Infotech. It would be absolutely wild. Equity risk premium actually upticked a little bit over the last week, which is unusual. Of course, we know that equity risk premium often is a concern in markets, and this can tell us that it's a better time to be in bonds than equities. But for the first time in a while, equities actually started to poke above bonds in terms of overall value. This week is also very important because we have PPI, inflation, CPI, and of course, we also have retail sales. 3 major bits of information coming this week. And we will update you guys on the show. JP Morgan, game plan, what do they believe? But here's Goldman Sachs one from Mike Siccardi over on X. And it basically says that they believe the headline will be 0.17 up, core will be 0.16, and year on year will be 2.93 and 3.2 respectively. Now, again, if we do end up seeing jobs numbers kind of stabilize and inflation does end up going back up, of course, it reduces how many rate cuts are we going to see. Instead of people saying 75 basis points, as they did last week, some people literally were saying that, we might go back down to 25, which would be a lot healthier in terms of the data and the stats. Hedge fund boosts bearish bets on commodities. I wanted to put this one in because it looks like hedge funds have gone all in on the short. And we know when they go all in on something, that's usually a bad idea. They tend to stuff it up. So now that they've stuffed it up and gone hugely short, we're starting to see signs of recovery in the energy market and the commodities market. This is a very important couple of weeks for commodities, and we will be following those. Another thing is interesting about Fed cuts. We posted this over on our X account after our previous weekend video, and it basically shows that during a non-recession, now this is only non-recession over the next 12 months, not non-recession in general, we would see some form of flash crash event into the rate cut itself. Now, you may say, well, it's different this time. Everything's different. It's always different. But it does make sense in some ways that we have this kind of flush out in markets, and how this reacts after this flash crash seems to be quite important. What happens after the rate cut? How many rate cuts did we get? This tells us whether the Federal Reserve is panicking, because remember, they do have data that we probably don't see. So if they start panicking, yeah, we should all be panicking, and you'll see that in the stats in just a moment. But how we end up trading over the next 100 days is absolutely pivotal to what happens over the next 12 months. So what a time to be in markets. Yeah, there's going to be some amazing stuff. But never forget what happened this week. That flash crash was a sign. It was a sign that this market sucks. This market has bad Its fragility is really high. It has, of course, poor liquidity sometimes. And the flick of a button, it could go absolutely down 10, 15, 20, or even up to 50% if we get a debt crisis. So do remember, we are in what we call late cycle investing. And you'll notice that when we have a look at a chart very, very soon. S&P 500, from the overall investor's perspective, everyone freaked out and they went super negative. We saw a massive crash here in investment intelligence reports. And this shows you, of course, that people were freaking out. And the markets almost came back to the 10-year average here, 5-year average here on S&P 500 forward 12-month PEs. So yeah, actually big tech started to get a little bit cheaper. And here are some of the reads of the normal PE ratios, which are still sitting around that kind of 18, 19 level, upwards of 21 on some of the high-end stocks. Normalized bubbles, how do they look? Well, have we reached a bubble? Yes, we're in a bubble. Of course, similar to the 1960s bubble, which we're also tracking, we're a little bit above that in terms of overall how big this one is. But there is an analogy. Each bubble will usually be subsequently bigger than the other one. So in this case, we have some monster bubbles. We've got the 1929 bubble that everyone likes to talk about. We've debunked that one a fair bit because, of course, we know that it doesn't look the same when you really put them on the charts. This one was so fast, the bubble of 1929 near the end. And then we have this one, which is probably the most interesting one, the tech bubble, the concentrated bubble of a new technology. This case is AI. Last time was, of course, the internet. Well, this is where the market comes into it. How does it perform through the last 12 business cycle peaks? Well, this market seems to be doing a lot better than the average usually would. And remember, markets sniff it out earlier than we do. So by doing these comparisons, it can help us figure out whether the market is telling us, yeah, we're really in a recession, or we're going to steal your money approach. And it does look like at the moment anyway, they're trying to nick or steal our money in this case. And that seems to be the big one. 50 basis point cut will also be a bit of a tell. If the Federal Reserve freak out and do a 50 basis point cut, well, that could put us on track for a very bad time, because in both of the last 5 cuts, when they did 50 basis points, we were going into a heavy recession or a heavy pullback. Whereas when we were doing 25 basis points, at least at the beginning, remember all of these, by the way, 1998 and 2019 led into crashes. They were just a little bit later on. And I think this is something that the internet and a lot of people are missing. We're not missing it, but we're sniffing it out. We're finding these things together. 25 basis point cut from the first fund rate. How does it look? Even in some recessionary periods or areas that went into recession, some of them did actually end up going into super bubbles. So again, super bubbles are possible. Here's some amazing dates. And the general statistics are, yes, after we get a rate cut, statistically, there are more recessions than non-recessions. So, of course, the Federal Reserve has generally stuffed the system at that point, and that becomes important. Here's the overall from the perspective of what happens coming into the rate cut and coming out of one. And you'll notice that when we look at the statistics, which we already have, we generally see around an 8% fall in the S&P. And in this case, what did we see last week? An 8% fall on the S&P. So we have to kind of suspect it's going to be a couple of months here of turbulence and then possibly back onto the bull run if the Whaley thrust holds up. Another important factor is, of course, it still is earnings week. This week is China focused with Tencent and Alibaba and JD. So make sure to be on top of those. We could get major turns here on those particular markets, which we've been talking about. And again, there are opportunities everywhere in the world. Although the US market is the best market in the world, no doubt, there are still opportunities out there if we see the right turns. And I think that is very important when we're looking at the charts. Now let's have a look before we go to the S&P 500. What exactly is going on year to date on these markets? How cheap are they? Well, the Russell 2000 went from almost overtaking the other markets the other day all the way back down. It's only up now 3.41%. The NASDAQ, as of the recovery, is up 10 and the S&P is up 12. So these are still pretty healthy numbers for the year to date so far, but certainly a nice pullback that kind of burns. And remember, burning time is the biggest thing here. It takes off around, 5 months or something of growth. So quite a lot taken off there. What I like to do, though, and we all do together, is that we look underneath the hood. Which sectors are weakening? Which sectors are strengthening? And I would like to point out that something that we've liked now for quite a while, and I often mention it, the old sneaky utilities, is the second best performing sector of the year to date. That actually blew my mind away. I thought gold might have been the second best GDX, but after the recent couple of sells, it's actually not the best. Utilities, out number 2, 18.14%. In what world did anyone think, other than maybe us, that utilities could outperform the market and more importantly, could actually almost get up there with the semiconductors. It has, and that's because in some ways it's like a proxy semiconductor trade. Of course, energy use is going up due to all these data factories and everything that needs in there. But semis, utilities, communications, GDX, more importantly, I look towards this one, XLF, and even regional banks, which were up a lot, eking out some growth. Now, it's important that we have home builders, banks, and REITs all showing positivity signs here. That is not a market so far that is showing the signs of an impending recession. Remember, don't look at what they say, look at what they do. And right now, they are buying REITs over the last 1.5 months. They are generally bullish on a lot of these home building sectors. I don't know why, but obviously they're seeing stats, these algorithm stats that are buying those sectors. And the main thing is that's important for us to watch and follow. And of course, it's what we do here on the channel. US 500 also bounced off some key points. We talked about the daily 200, and I just want to reiterate this. We did it in our Monday show. I will post that at the end of today's video as well. Go back and have a look. We actually did it live where we were like, wow, this is going to be amazing. And one of the reasons we like the daily 200 so much is because whenever we see a crashing event into them, in general, even if it hasn't held, which it generally does, the first bounce usually holds. If it doesn't, it comes back up and tests that area. So this will be something that I would suggest you put on your charts and watch very closely over the next coming months, the daily 200. Another thing we're going to be wanting to do is to watch this zone this week, 5400 to 5440. This is a very pivotal area. And of course, if you load up things such as Fibonacci, you'll notice that we get a lot of 61.8 fibs, the golden pocket, we get anchored VWAPs, we get structural zones such as supply. There's a lot to like about a bear trying to have a go at this zone. So if markets are able to actually go over the top of that and find significant strength up here, that'll be a big one. But for people that are wanting to try to short and saying this thing is crashing, this will be a key zone. To look for a turn in here could be one of the biggest points that we've faced in markets in the last couple of months for sure. So we'll be watching, and of course we're paying a lot of attention to this zone. So make sure to pay attention to that. But I want to go over to some more charts. Firstly, central bank liquidity. We know that central bank liquidity has been injecting over the last week because central banks are gutless, so they instantly try to support these markets. And we also know that other thing I put in the previous video, so check that out, which is that if markets are going to consolidate here, they often do so for about 9 to 10 days, and then they're going to make a decision. Is that decision towards the bear side, like it was this one time, or in the statistical side, it was actually bullish over that period? So certainly an interesting one here. A lot of people looking at it from a bear flag perspective. And again, the daily 20 moving average will sync up with that 5440 as well. Let's have a look at some other things. Gold, does it look good? Yep, gold looks pretty good on the charts. Had a nice strengthen off 2380. We, of course, like 2357. We also like 2320, 2330 in the future. But the weekly closed okay, found a bit of bouncing, and still holds the weekly mean reversion at the 20. So in general, this thing is melting up, and it's still on track potentially for that $3,000 an ounce that we're looking at. But it wasn't actually gold that I want to talk about. I want to talk about silver, because silver was horrendous in recent weeks. It's fallen off big time, and you'll notice here with these long-short ratios, which is partly why we're making this video, if you look at it, silver is back down to a 0.011 ratio. Now, this is getting historically low. It's very, very low. So it basically tells us that silver is cheap when compared to gold price. Now, why could that be? Well, silver is not quite just a precious metal. It's also a used metal. So like copper, like a few of these other metals, they've all suffered in recent weeks. But silver hit a major zone. It hit this major support area on the weekly, the 2650, and we saw some buying off that on the daily. Of course, we've got a long leg doji here. We weren't able to close above this super switch zone for silver, but still the signs of potential recovery are starting to come through. So for swing traders here, silver is an interesting one. What do you guys think though in the comments down below? Do you like silver? Do you think it's a useless metal? Do you like it very much? And what do you think about the structure? Because the structure is looking pretty good. Of course, it could be setting up for a flag here, which is not my favorite pattern in the world or anything. But if it does breach out, it makes sense. It's structured in, found some accumulation, good base, and of course, cheap compared to gold's hold throughout the world. And we know that gold's being bought by central bankers. It's a currency war at the moment, all sorts of things that are going on. So that's going to be key. Another interesting one is some of our stats. We call this the American consumer discretionary versus staples. Why? Well, this basically says we have excess money to spend, And this one says we need to buy food and live. And at the moment, it looks like staples are, of course, doing a little bit better. What does that tell us? The market is starting to inherently get defensive. So, of course, XLU, XLP, XLV, all of these should theoretically be turning up and starting to show signs of a market that is starting to weaken underneath the hood, even if it is going strong. You know, the last time we saw that? 2018-19. There's a lot of analogs there with this one and, of course, where we are right now. So this is showing us that there is a weakening. Now, if we just go XLV versus SPY, which I encourage you guys to run a lot of these cross codes. I talk about them in our advanced course because it's very important to do so. You would notice that actually healthcare's been outperforming the SPY even before this crash stuff started happening. It's already been showing signs. Now, the last time it did that was during that 21 into 22 fall, which of course was defensive, but it also did it, when you think about it, during that 18-19 period where we saw XLV doing quite well over that period. Now, also XLU, which of course is a key combo, that has also been improving in recent weeks. And again, it's based off since we started talking a lot about it back in February and March. This is when we started to realize that XLU could outperform the SPY based on these factors. And it's not just there, it's just pretty much across the board. Another thing we'll be looking for whenever we go for crashes is, have the financials crashed? What about XLF versus the SPY? How has that been looking? Well, you would notice that for a long time, during 2020 crash, you can see how it affected it. But even leading into the 2020 crash, XLF wasn't exactly performing that well. Late cycle was definitely engaged. At the moment, XLF has actually been improving, which is telling us that the debt market seems to be quite strong. If we put in XHB versus SPY, which is basically home builders, you'll notice here we also have a strength in this economy. It's very bizarre. Like, is this really an economy that is blowing up? Well, probably not based on these charts right now. If it changes, of course, we need to consider that. But you will often get a little bit of an edge from these particular reads. Where some worrying signs are, of course, copper and metals. That's basically telling us that, yes, we're going to get interest rate cuts. Yes, things have changed here. And we'll be watching for signs of strength in copper. If that doesn't happen, of course, it can lead into bigger issues because metals traders don't tend to be very stupid. And what they've been going for a little while now is a rate cut. They were going for rate hiking earlier in the year. They've changed their tune at this point. So if this changes, then of course, it'll be a stabilization of how many cuts we're going to see. And probably a lot of that's going to come in when we think about it after we see whether we get a 25 basis point or a 50 basis point cut by the Fed in September. I'm going to run a poll. I'm interested to know what you guys think. Will they do a 25 or a 50 basis point cut? Semiconductors as well. This is an important market. We know that SMH hit 200 this week. That was so important, or last week now. That was such an important point because we needed to know that that level held, and we've seen semiconductors versus the SPY weaken significantly. Actually almost changed trend towards the downside, barely holding on here in the combo. But they did bounce up. We need semiconductors to now start leading again, and they have to lead us out of this fall off, because if they don't, then it tells you the strongest, the most important sector in this market right now is weak. There's something wrong with it. And that means that in many ways, the bubble could be already ending in front of the charts. So is it still bullish? I would say yes, it is still bullish. Yes, we expected this type of pullback to occur. Now the question is, how much can it recover? And of course, I think this is a very important chart to be watching. NVDA in particular will need to be on our charts, and we'll need to keep watching it. We do that here daily on the show. So of course, we check that out and we make sure to pay attention to it. An interesting one, pulling off the 61.8 fib, needing to break through a 110 this week, and then possibly go towards strength. But I really think the biggest chart here on the charts is going to be the US 500, 5400, 5440. That level is such a bearish zone that we'll see how it ends up reacting. Another one that we've been talking about a little bit has been XLE versus the SPY. It started to show a little bit of uptick. Again, a very strongly correlated sector with yielding, so we need to watch how this trades. And some people are saying, well, what about this being an inverted head and shoulders, and therefore showing that strength? Well, yeah, it's possible. This is certainly a very key point for XLE to show some strength. So everything is starting to point towards, if these metals keep falling, that's a big problem. They must start to find buy supports. We need commodities to find buy supports. They're oversold by the hedge funds, and that's why I thought I'd bring it up, because These levels are very, very important to see whether there is continued strength in these markets moving forward. Another one I thought was interesting to include here is going to be crypto. What's going on in Bitcoin? Well, Bitcoin rebounded all the way to the golden pocket, 20 daily moving average and everything else. And it's found a little bit of sellers here, which we suspected it would do. But I think actually more importantly, even Ethereum, if you really start breaking this down, you look at the structure, although it is weak, there are still should be pretty strong buyers around 2,400 and of course the equivalent for Bitcoin. So this is going to be a very important week for these markets. They make new highs, good signs across the board. 54.40, how it interacts with that point, one to watch this week. And in general, I feel like when you're looking at the SARM rule and the unemployment rate and everything like that, it does, yes, it has a 100% track record or very close to calling recessions. But at the same time, the market doesn't seem to look the same. And it generally will look a certain way because it's a lagging indicator. Usually the market sniffed out a recession and problems like that using those rules. The question then will be, will AI recover? I'd be interested to know your thoughts. Let me know in the comments down below. And of course, this week, guys, we have, just to remind you guys, we have PPI on Tuesday at 8:30 a.m., 8:30 a.m. core CPI. This is the number. We'll get JP Morgan's game plan and discuss that soon over on X and on YouTube. And then core retail sales as well. So much going on. Hopefully you enjoyed the video. Bit of a special here to go through a few things. We'll see you live for the Monday Open as well. Looking forward to that. And follow us over on X if you want to find out more about some of these charts and check them out for yourself. Thanks, guys. Have a great weekend. Bye for now.